Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to be here, Jeff.
Well, it's great stuff. We were seeing the stock market rally continue. This trade tariff conversation remains optimistic, but what's your focus this week, Bob, as there's a lot to digest?
Yeah, there is. I'm hoping to see a little bit more positive comments out of companies going forward. As we get closer and closer to a potential trade deal, it gets now to the point where earnings have to improve and guidance has to improve.
Understood. And we also have Fed Chair Powell. What are your thoughts on Powell grabbing the microphone today?
Well, I think he's going to remain as dovish as he was in the last meeting. The notes from the January or December meeting, rather, bore that out. So I think he's going to continue to go in that sort of vein with the Senate and the U.S. Congress.
I think that's right. You will see continued follow through on that about face or that dovish tack that they're taking currently. All right, Bob, you ready for this first lightning round?
I am ready.
One crude tweet. Well, we did see a very interesting tweet out of President Trump yesterday talking and asking for a little bit lower price in crude oil. What are your takeaway from that tweet? Because it really moved markets.
Yeah, it did. And one of the things it did is it gave us an opportunity for a good trade example because it spiked volatility a little bit, which we hadn't seen in crude oils. We saw 7 consecutive weeks of lower vol.
That's right. And that trade example, to give you a little pat on the back, that trade example last week where you were selling that call spread, collecting that premium, that really worked into your favor due to the fact that this tweet lowered the market by about 3-4%, correct?
Yeah, it really did. And it seemed to be good for the range we were looking for. So again, as we saw the vol spike with this tweet, I think as an example now, I'd like to look at selling a week 2 March 54 put for $520 and buy the week 2 March 52 put for $200, taking advantage of, again, that slight increase in vol. The selling of this put spread allows an investor to collect $320. It's a $2 put spread, expires week 2 in Friday, March 8th. March is the underlying futures contract, and the time of pricing the option, crude was trading about 55.72 or so.
No, that makes a lot of sense, and that at-the-money volatility certainly has decreased down to 30.45 as we price this trade example, but at the end of the day, you're taking and embracing volatility. Last week it was a trade example, selling a call spread. Here you're selling a put spread. I like the way you're really focused in trading inside of this range that's in front of you, not essentially the trading range that you want, correct?
Yeah, continuing to play the range that the market's showing us. It doesn't really matter to me what I think is going to happen. What's the market showing us? Let's take advantage of that.
Fantastic, Bob. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
Let's do it.
Trade tariff extension. Well, it is interesting to see. We all expected the can to be kicked past March 1st, but a lot of people have a lot of optimism going in. There's going to be something tangible, something in this trade tariff or this deal between China and U.S. that we can actually sink our teeth into, Bob.
Yeah, I agree. I mean, once we get the deal and we get the details of it, there could be some volatility added here, but currently it's just status quo.
Well, in a trade example I want to utilize here, this is a short-term perspective, but we've seen just a sensational run-up ever since December 24th, Christmas Eve. So the trade example I'm looking at is the seller risk reversal in the E-mini S&P 500. And what that is, Bob, is selling the E-mini 28.25 week 2. That's next Friday expiration. I can sell that call for about $495. Yes, it's only 1% out of the money, but this risk reversal and the approach is the thought that we've come up too fast, too far. On the other side of this risk reversal, I'm going to be buying the 2,700 week 2 put for about $200. Bob, this is a net credit spread in a collection.
Here's what I really like about this. We're only about 1,000 points away from the all-time highs in the Dow without a deal yet. So I think you're right when you talk about us going too far, too fast.
And one other thing to really consider here is the fact that I'm only going out 7 to 10 days. When we saw the volatility in early 2018, that allowed a lot of these trade examples to go further out. Now that we've seen a much more volatile environment, despite the fact that we have seen volatility erode in the last 20 trading sessions, I still want to have a tight time frame on these trade examples, 7 to 10 days out. So that makes a lot of sense as this trade example expires March 8th, and March E-mini S&P 500 futures contract is the underlying. And this price was trading around $27.97 with the at-the-money vol around $12.24, Bob.
Yeah, something to remember, the shorter time frame is one of the ways you manage risk on top of looking at options as trade examples.
And this trade will allow an investor to potentially collect about $300 on this credit spread. Remember, a lot of these risk reversals you can put on for a net zero cost collar or essentially a net credit spread. But at the end of the day, the way you approach this is thinking with the mentality that the equity market is a little bit out of gas here, Bob.
And again, that short time frame without having a deal in place, that's probably the time frame you want to focus on until we actually get one.
All right, pal. Thanks as always for joining Striking Options. Please tune in every week as we will continue to strike options.